again. It's Samu Joseph on your screen, and today we're going to be talking about a special concept, the concept of liquidity, right? So why is liquidity important? What is liquidity? Why should we be considering liquidity? These are some of the questions we'll be answering throughout the course of this video, and here's my promise to you, okay? That leads me to my objectives. At the end of this video, you should be able to, one, identify liquidity in the markets. That's the first thing we should be able to do. And two, we should be able to identify entry opportunities after liquidity has been taken out. So that's the reason why we want to identify liquidity, know where it is, know what forms it exists in, how we can identify it, and how we can place trades using liquidity as one of the confluences would apply to our trading strategy. All right, so let's jump right into it. So then, what is liquidity? When we talk about liquidity, what do we mean? Well, basically, liquidity refers to how active a market is. It's determined by the number of traders actively trading in the markets at a particular time and the volume, the trading volume that's being generated at that point in time they are trading. Okay, so liquidity exists in various forms in the market, but why is this important to us? Let's cast our minds back to our previous videos and the previous things we've talked about in our last video. We introduced ourselves to the concept of the composite man. We talked about the Wyckoff theory. We introduced ourselves to the concept of the composite man, and we had this hypothetical example in our mind about Enigma, which happens to be, let's say, an algorithm, for instance, that places trades in such a way that it engineers this liquidity and then takes out liquidity. What do I mean by engineering liquidity and taking it out? By simply making people feel this is the right time to get involved in a market, getting them involved in the market at that time, and then taking out their orders so that they can push price in a direction that they want to go. By they, I'm referring to Enigma now. So let's build up our story from there and apply it to the charts and see how well it can help our strategy and help our understanding of how the Forex markets work, or generally any market you're trading. Okay, so let's talk about it. Now recall I talked about the concept of Enigma and Wyckoff, yes, and we talked about how price moves in such a way as to engineer liquidity, take it out, and then continue its movement, right? So let's talk a little bit more about that. Now, when we are talking about liquidity in the markets, before we consider liquidity itself, let us understand why it is important for us to even consider it in the first place. Now, if you look on your chart, you would definitely agree with me that you don't see price move like this every day, right? So if price moved like this, each and every person who jumps on the chart would be a profitable trader. All you need to do is just look at where price is going, see where it's been coming from, and you'll be able to place a trade, have your stop loss below a certain area, and then have the markets move directly to hit your take profits. But that's not the case. Why? Most of the time you see price with so many charts looking so shabby, and that's why we started off by talking about where our structural points are. We discussed structural points, and we talked about isolating a trading range. We talked about defining entry reasons for us to take a trade. That's getting our premium levels, our discount levels. That's all trying to take out the noise from our trading and make sure that we are entering in at the areas that we are interested to enter in, and also build a reason-based system for us to take trades. Now, we were also able to identify certain areas or certain trade opportunities based on trend, that is, to form a bias to the kind of entry we want to take. Either we are buying the markets or selling the markets, however the case may be, based off of structure and the information that we have about where price is and where price is going. Okay, so we said in our previous video that when we have price trending in a certain direction, let's say it's an uptrend, we'll be looking out for buy opportunities. And we said if price is falling, we're looking for selling opportunities. Then we're able to identify order blocks. We said other blocks are those areas that we are looking to. They are demand or supply zones, as the case may be, either in a bullish market or a bearish market. That's either we are looking to buy or we're looking to sell. there are those areas that we are looking to get involved in. And we said other blocks are formed after a demand zone is being created. That's after liquidity has been taken, a demand zone created, and price moves. Then I promised to talk a little bit in depth about what this liquidity meant. And we defined it to mean the active number of traders and the volume that is generated per time on the charts, right? So let's say, for instance, a lot of people feel the market is going to buy. Let's give a hypothetical example. If you're looking at something, a commodity, an asset, whatever it is, and everyone is buying that particular asset, who is selling to who then? That's an important question you should ask yourself. There should be, at every point in time, I don't want to go into the concept of liquidity providers and go in depth. I'm trying to pass across a mentality to you so that we can utilize that to understand liquidity on the charts, right? That's what we're trying to do right now. So just follow me. Now, for price to move from one point to another, that if price is moving bullish, it signifies a lot of buying pressure, right? But if one person is buying, it consequently means some people are selling to these people who are buying, because where else do you buy from? You buy from one who is selling to you, right? So just follow me, please. So in the same way, Enigma tries to engineer price in such a way that certain people feel price is going to fall and they get involved in a sell. And when they are selling, Enigma buys at cheaper prices from them and then proceed to push price to whatever location they want to take it to. The reverse is the case in a sell market. Now, this is a hypothesis. It's not proven to be true. I don't have logical example, but based on the information we see on the charts and how it respects these levels and it respects this idea of trading is why we utilize the concept of Enigma in our trading. I hope you completely understand. So we're applying these concepts to the charts and seeing how we can form a trading system based on this idea. And that's what we're trying to do now. Let's go back to liquidity, what it is, and how we can utilize it in our trading. So we said the composite man delivers price in such a way that sellers are taking out, buyers are taking out, and then the move occurs. How does this happen? That leads us to the first thing. Remember our definition of liquidity again. The amount of active traders in the markets per time, and the volume, it's characterized by the amount of trades they are taking, the volume that has been generated from their trades. Good. So let's say price is to push to the upside, but first of all, you notice something. You notice that price behaves in a manner like this, right? You see price push, then there's a little bit of an accumulation, then it pushes maybe lower, even lower than where you were anticipating the buy, and then it shoots up to the other side. This is for a buy market, and then you see a lot of movement, all not without reason. All of this movement is in a circle just to engineer liquidity, take it out, and repeat the circle over and over and over again. Now, there's not just one template that it follows. It can come in any way, and this will lead us to the various ways in which we can identify liquidity in the market. Sometimes we may see liquidity as in terms of double tops, double bottoms. Let's just call them chart patterns generally, in chart patterns that you are very, very familiar with. So why should liquidity be engineered in this way? I'll give you an instance. If you see a double bottom and ordinarily the first thing that comes to your mind to do is to sell, that's a pattern that has been created. Then when you see a double bottom and you sell, how is liquidity engineered? You have fallen for that trap of taking that sell trade. Now, sometimes it goes in your favor, you're able to make a quick buck from it. Good. But other times, that liquidity, that trade you are holding, or that trade you got involved in, was only liquidity just being engineered for it to eventually get taken out for the real move to occur. Or let's say you are looking to buy initially and you've identified an area that you love to buy from, but the next thing you see is you see something like maybe a double bottom, and then you're interested in taking that buy at the double bottom there. What do you know? Price rallies up from that double bottom, giving you this ecstasy that price is eventually going in your direction. When you get involved and you have stops placed, price reverses takes out your stop losses. By taking out your stop, what is it doing? They've taken out that liquidity. Remember from our definition, the number of active traders and the volume that is being traded. After that liquidity has been taken, it is now used as fuel to fuel the real move that is about to happen. That's why we say liquidity is the fuel of the market. The market always moves in a bid to create liquidity, take it out, create liquidity, take it out. It just follows that circle, and it happens all over and over and over again. And there are different ways that liquidity can exist in the charts, one of which we've been talking about in terms of double tops and double bottoms, or chart patterns generally. So when you see this in the market, you should be wary. Look, it points to you, it gives you the idea that, okay, liquidity is being engineered. What is majority of the people who are trading this currency pair or are trading this asset class or this commodity, what are they doing right now? If they are looking to buy, then you should be cautious. If they are looking to sell, then you should be cautious about entering that trade. Why? Because you should understand that liquidity is being engineered at that point in time. Then your job as a trader right now, trading, these concepts, would be to look out for opportunities that will enable liquidity to be taken out first, and then wait for the real move to occur. And how do you do this? You simply do this by following the institutional footprints. You follow the footprints left by Enigma. What I mean by this is, once you see liquidity being engineered in terms of double tops, double bottoms, and there's a zone that you're considering, maybe a demand zone from previous price action that you've seen on the charts, you wait for price to take out that liquidity and fall into your zone before you go ahead and execute. Why is this important? This is important because it will help you to eliminate the noise. You now begin to know which other block should you be taking a trade from, and which one should you ignore, which one is a trap. There are some other blocks that we refer to as smart money traps as well. Not only retail traders can get trapped, smart money traders can get trapped as well. So in your trading system, you have to apply caution and think in this wise, that if the market is about to go up, a lot of people are going to have to exit their positions for Enigma to take price to where it wants to take it to. If you've not understood any of the things I've said, I would implore you to please go back and watch this video from where I started to where I am now. So let's proceed and look at some of these examples on the charts and see how it plays out and how we can get involved in trades like this. Okay, let's take this out. We are currently looking at GBP USD, and we'll just go ahead with that. Let's even price out so we don't have an idea of the price action we are seeing, and then let's look for a trading opportunity. Okay, let's utilize the replay tool. Let's take it to, okay, let's do this here. So now let's look at this price action. Okay, so based on what we can see from here, what do we notice? What can we see from price? Remember, it's all a process, it's all a procedure. So let's go ahead and look at it together. So price has been in a downtrend, printing lower lows and lower highs continuously, right? And then all of a sudden, we're seeing something change. This was a lower low, a lower low, a lower high, lower low, and then this has been taken. So let's go ahead and see something. There was this push, yeah, we're following, push, there was a correction, there was a push, it still didn't break this trend, a correction. Now there's this push starting all the way from here. Let's go ahead and play one candle at a time. Let's do it this way. One candle at a time. What do we have? We have a take of this liquidity on the upside. Just follow me. We're not looking at liquidity for now as at yet, but I'm just trying to call your attention to it. Liquidity would appear in the market in forms of double tops and double bottoms. That's one. Two, in areas where you would expect people to have their stop losses, you would have liquidity at those areas. All right. So let's say those who are involved in a sell here, where do you think their stop losses would be? If you were like me and you guessed correctly, they are going to definitely have their sells, their stop losses here above certain structural areas. So when those areas get taken out, you already know that liquidity at that area or that region has been taken out. So let's just follow me. So remember how we talked about identifying a trading range? All of our trading activity, we're going to start from there as well. So let's say there's a push, there's a correction, There's a push to the upside. There's another correction. There's a push. We haven't seen any correction as at yet. So let's see. Once we see a correction, we'll use that to identify our trading range. All right. Okay. This looks like a heavy enough move to pass as a correction. Okay. Let's see. Okay, great. Now, most times there are areas of no trading opportunities. You just have to wait for price to imprint something so you know exactly what's happening. So right now, where can we identify as our range highs and range lows? If you're like me and you guessed correctly, you'll be picking this as your range low and picking this as your range high. So this is the range we'll be working with, and we'll be looking to trade from here. So let's go ahead and, why did I pick this? Why didn't I pick this? Let me answer that question. Let's look at everything that has happened. Taking our structural areas, we have this, we have this, we have this, we have this, we have this. There was no correction as at yet after this high was broken, right? We just have small reactions, but this looks like a correction. So that's why we're marking this out as, as our trading range, excuse me. And then I was also taking this high. So now we're considering an uptrend. Looking at what we have here, we're considering an uptrend, okay? So that's why I picked this zone. So we have our ranges marked out already. After we've marked out our ranges, what's the next thing we look out for? Premium and discount levels, right? So let's go. So we have our premium and discount levels already. This is our premium level. Where's our discount? This would be our discount level. Let's see. Discount. So yes, so if we're looking to get involved in the markets, we'll be looking to get involved at our discount levels. We're still considering liquidity. Remember, there are other blocks you can see. Great. If you're beginning to see them as well, then I must commend you. You're doing a great job studying the charts, because your eyes are getting acquainted to looking at all of these things. Okay, so we have our premium level. We have our discount level. Now let's look at how price reacts at certain areas so we know exactly what to do. Okay, let's play this out. One candle after another. One candle after another. Now I would like you to look at something. If you looked over here, at this price action here, you would notice some form of relative equal lows before that was taken to the downside. Yeah, what are we having here? Equal lows again, equal lows, right? Equal lows, equal lows. What do we have here? This is an order block sitting just right at our discount area, or rather sitting just right at equilibrium. Right at equilibrium. What other blocks can we see? We have this one here, right? So this is one area we're considering as our POI. This is another area we're considering as our POI. Now, we talked about having your order blocks at areas that are close to liquidity, right? So if you look over here, what kind of liquidity do we have here? We have double bottoms, relative equal lows. This is a low, this is another low, price has pulled out, and then we have an order block just sitting underneath it. Let's go ahead and play and see what happens. The other block, remember we talked about the concept of imbalance. You can see the imbalance, it was almost completely filled, right, by this candle over here, almost completely filled. So we have another block, we have an imbalance, we have liquidity. Now this gives us some reasons to enter this trade. This increases our reasons to enter a trade, right? Let's follow through one candle at a time. Okay, we have a tap into that area already, into our order block. We have a tap just after taking out this liquidity. So you understand what we now mean by markets taking out liquidity. Let's see if price will pull lower into this area before pulling out. look at the move that just happened after price tapped into this area, after taking out this liquidity. Price didn't even get to this level, right? Price didn't even get to this level before you saw this move, because there was liquidity right over here. It's still at our premium price, didn't even touch our equilibrium price. Let's go ahead and move further, see what's going on. Okay, so if we're going to take this trade, we would have already been in approaching our take profits now. What else do we have here? You guessed right, another block, but this is not a sell market. We are not looking at a bearish market right now. We are looking at a bullish market. This liquidity over here has just been taken. This has also been taken. So we are looking at a bullish market. So what we are expecting, the most likely thing to occur is we might see price break to the upside. But however, if that fails to happen, what we should see is we should see price reverse around here. Why? Because this is another block. It took out liquidity, internal liquidity, hasn't taken out external liquidity. Price hasn't dropped to our discount level yet. So there's every tendency for price to reverse from here and pull into our discount levels. Let's just see what happens. Okay. We have that almost completely filled. And you can see we have price reversing now. This is just to remind us about other blocks, right? What do we have here? We're having an accumulation. And yes, price failed to break above. But now what do we have here? We have liquidity still engineered here in terms of what? This low. This low didn't lead to a break of structure, so this is not a structural point. It's still held here. So what will we call this? This is internal liquidity. So we have liquidity resting beneath this point here. That's what we need to have at the back of our minds. So we should expect that since this move didn't lead to a break of structure, there's every tendency, it's more likely for price to come and take out this liquidity. It didn't lead to a break of structure. So let's see what happens. A candle by candle basis. There's liquidity here. This looks like another block. Let's see if price is going to react from here and push higher, or price will take out the liquidity we have over here. Okay, let's watch closely. What else did you notice here? An imbalance, right? And what happened after the imbalance? Another block. Now, there are instances where you might see selling opportunities in a buy market. We call this counter trend trading. I won't advise us to look into that, and I won't discuss much about that now. Probably in a later video, we're going to discuss a little bit more about that. For now, let's focus on trading with the trend. Remember this mantra, the trend is your friend. So don't try to trade against the trend, all right? So let's keep going. Let's go. So now we are having lows taken out, but this is not a structural point, so we can't call this a downtrend. This is still liquidity being engineered in the markets, making people sell, buy, but we're not looking to get involved in all of that. All we need is to see an opportunity close to a structural level at either premium if we're selling, or at discount if we're looking for buy opportunities. And that's what we're looking for still. All of this is still liquidity being engineered right here. You can see candles buying, selling at the same time. This was the liquidity. Let's look at this. Now you can see this aggressive raid on this low. That tells you something. That tells you that that's a run of liquidity. And after a run of liquidity, once you know that liquidity has been taken, as was the case with this move, what are we looking to do next? We are now approaching where? We're approaching discount levels. We are close to the equilibrium price. So what should we be looking out for? You said it correctly. Buying opportunities. Buying opportunities. Why? This was a low and a lot of people have their stop losses here already. This move has raided that low, which means even if we don't have a full-time push to the upside, we can start looking out for shorting opportunities. We already have another liquidity being engineered here, and like I said, price moves from one liquidity point to another liquidity point. So we're looking at price taking price from one form of liquidity to another. We've talked about liquidity in terms of double tops and double bottoms, chart patterns. This is also a chart pattern. This is a trend line, which means what? We have traders actively involved here with their stop losses all around here. Let's mark that out. We have stop losses here, we have them here, we have them here, we have them here. So what are you expecting? For price to take out these stop losses too, to take out all these people who are also involved in selling at that point in time, right? Because we're in a what? We're in a buy market. So after we see price raid this low, taking out this double bottom, taking out this liquidity, just like what happened here, what do we expect to see next? Let's see. Notice immediately what happened. What do we have? You can see how immediately price took out this liquidity. This is the concept of liquidity now playing out. Immediately after the liquidity was taken here, in terms of stop losses, or those who had stop orders in terms of sell stops beneath this point, because why? They saw a double bottom here, which means if this level gets broken, they will expect price to keep pushing to the downside. All traders who got their stop orders triggered here, their sell stops triggered here, have been taken out of the market. Those are traders who are looking to sell. Those traders who are looking to buy from here or buy at this point, they've also had their stops taken out by this run of liquidity already, right? Now, where are we heading to? You can already see price already hitting liquidity areas. Where else do we have liquidity? Over here. Let's see if price is going to get there. This looks like an order block that we have here. So let's say we take out price. We exit this trade around here. So we talked about using order blocks as both our entries and our exits, but I'm just emphasizing on how liquidity can play an important role in our trading, how liquidity helps us to identify the order blocks that are going to hold and those that are not going to hold. All that has happened here, we didn't see any liquidity point as closed by, we only saw an order block. We can't trade out of context. But over here, why did we take this trade? Because we saw liquidity here in terms of an equal low. So we took the trade. However, it failed to break to the upside and price kept on falling. And we knew that we're still in this zone. Price got to the equilibrium price. That was the midpoint of our range high and our range low. We saw an entry opportunity off of this other block still that reversed price, but it had a wick to the downside. And we're considering that wick. We placed our entry there and we got a nice 1:5 trade. Let's play it out and see what happens. And yes, price just hit our stop loss, our take profit, beg your pardon. Price just hit our take profits and you're already in a good 1:5 trade using these concepts alone. So you can see how easy it is to combine your knowledge of trading ranges to trading zones, areas where you should be looking out for opportunities, as premium area and discount levels, trade levels rather, premium levels, discount levels. We narrowed it down to order blocks, and not just every other block, because we could have well just taken this other block. Why? Because it's deeper into our discount level. But why did we consider this one instead? Liquidity. Because market looks to seek liquidity. It might take this liquidity and keep dropping. It might take it and reverse immediately. But one thing is certain, almost every time price takes liquidity, it reverses. Almost every time that price takes liquidity, it reverses. Always have this at the back of your mind, except its intention is not to continue in that direction, but usually that's what happens. Once liquidity is taken, it might be a reaction, it might be just a little reaction before the move continues, but usually there's a reaction or a movement away from price every time liquidity has been engineered and successfully taken. Let's put this all together and let's recap what we've talked about so far. We've talked about market structure. We said market structure refers to the delivery of price with highs and lows in the market. And we said this is important because we want to be able to identify a trend, and a trend is characterized by the highs and the lows that we have. If we have higher highs and higher lows, it's an uptrend. If we have lower lows and lower highs, it's a downtrend. So once you identify the trend based on structure, the next thing you're looking out to do is to identify regions where you can trade from. That leads us to our shortcut method of identifying a trading zone or a trading range. We said a range is marked with our 2 to 3 moves. So we have a push 1, 2, 3. And then our range is marked from our 2 to 3 move. We mark out this trading range with our range high and our range. Let's go ahead and identify them here. This is our range high. Over there, this was our range low. over here. Then we have our premium levels, we have our discount level, and we have equilibrium, which is the midpoint between the buying and the selling. All right. So delving deeper, we said the next thing we should look out for are other blocks and areas where we are looking to get involved in the market. And other blocks can happen randomly anywhere on the chart, right? It doesn't have to be after liquidity has been engineered, or rather, it doesn't have to be at that every other block you see on the chart, or every time you see a candle engulf another candle, you call that another block. That's not the case. Other blocks have to be at certain demand and supply zones, because those zones are what forms the other blocks in the first place. So when you notice them at those areas, you identify them as your area of interest, which means these are the areas that you are looking out to take a trade from, a POI, a point of interest. Then when price gets to your point of interest, you look out for an entry around those areas. Now, one of the criteria we've been used to able to identify another block that we would like to trade from while ignoring the other one is this: liquidity. We said liquidity is the fuel of the market. So once price takes out a liquidity, or once price takes out liquidity and forms another block, we look, or we give more respect to that other block that was formed at that point, at a point of interest, either close to a structural area or at a point of interest, than any other block that just randomly occurs. And that's what led us to opening this trade, or taking this particular trade. We looked at another example here. We saw that this was an area, it was a decisional, it switched price down. So this was a higher high. And when we saw price take out some form of liquidity over here, price took out liquidity over here and came into a POI. When it got back there, price failed to break that area. Instead, it engineered liquidity again, gave us a move out of that zone, broke some form of internal structure. So this passed as an order block. Once we saw price push back into that zone, if we were active sellers in the markets, we'll be looking to sell from here. But I refuse to use this as an example simply because this is an uptrend. Now, you can either be a pro-trend trader or a counter-trend trader, but it's more safe to be a pro-trend trader. You're trading in the direction of the trend and you're not trading against the direction of the trend. Now, in our more advanced classes, we see people who take both the buys, they take the sells, they're trading according to the trend, they're trading against the trend and holding all these positions. That's where you see different terminologies coming in, like the spirit advocate trades. I got that concept from a WWA course anyway. That's from Wali Khan. He talked about, devil's advocate trade. We call it the spirit advocate trade. And, you are able to get in at different levels, both for buys and sells in the same trade in a particular trend. You are trading both pro trend and counter trend. But there are some more advanced concepts that we'll look at before we introduce this to you. But for now, the benefit of identifying liquidity, having it close to an order block, is to help you isolate the proper order blocks that you should be taking your trades from. Again, let's just do a quick recap of everything we've said so far. We've talked about these areas to trade. We've talked about the premium and the discount level. We've talked about the order blocks. Now we added another form of confluence to it, which is liquidity. We said always look out for areas where liquidity has been taken. Why? Because liquidity is the fuel of the market. And how do you identify this liquidity? We said there exists in terms of double tops or double bottoms. That's chart patterns, right? So it could be a trend line. So we can have trend line liquidity. All these I've mentioned are all forms of visible liquidity, the ones you can see easily on the chart. But how about those you cannot easily see on the chart? I'll give you an example. We have what we refer to as the Asian range liquidity. I'll not be discussing that in this video. There are some more advanced concepts. We have the Asian range liquidity, we have previous days liquidity, previous session liquidity, and all of these. They are not just easily visible on the chart, but with the help of some technical indicators, you'll be able to identify them. We're just taking this one step at a time, forming a very simple, tradable approach or rules-based system for you to be able to trade within the now. That's why we're not considering these concepts now, but some of them are made available in other videos, even some videos we have on YouTube. So if you're not following us on YouTube, if you're not subscribed on YouTube or on our Instagram page, immediately after you watch this video, head over to YouTube, search for Elevate FX Academy. That's ACAD Acad, Elevate FX Acad, and subscribe to our YouTube video so you can get some more of this kind of content. And also in the community, we discuss these concepts more in depth, so you'll be able to benefit from them and understand them. But this will form the basic idea behind which we will build on later on in the future. So if you found value from this video, give it a like. If you have any questions, drop a comment in our community, in the chat box in the community, and we'll answer them as promptly as possible. So until the next video, I'll see you later. Bye.